Welcome to the deep dive. Today, we're looking into something a lot of you have asked about, the American dream. Is it still a thing?
Yeah, we got this prompt from a listener who shared a YouTube video. The title, well, it's in Chinese, but it basically translates to, "The American dream is over. Most Americans can't make ends meet, can't retire, just work till they die." Pretty stark stuff.
Wow, yeah, direct. So this deep dive is about getting past, the headlines and really understanding the financial picture painted in that video.
Exactly. We're going to try and pull out the key insights about the reality facing, well, many average people in the U.S., based purely on what this source is saying.
Okay, so the video kicks off with a really important point about income. It's about the difference between average and median.
Right. It uses this analogy, like imagine averaging your income with, say, Jeff Bezos.
Yeah. That number wouldn't tell you much about your situation.
Precisely. So the video argues the median income is a much better guide to what a typical person actually earns.
It gives an example.
It does. It looks at a state like Mississippi. Their median weekly earnings work out to roughly $18 an hour, assuming a 40-hour week.
Okay, $18 an hour.
And the video points out, interestingly, that even that is, well, quite a bit higher than the federal minimum wage of $7.25.
Right. So then it looks at more populated states.
Yeah, it suggests that in many of those, the median hourly wage is kind of hovering around, say, $20 to $22 an hour.
So not drastically higher for many people.
Seems to be the implication in the source, yeah. But then it gets more complicated when you look at high-cost states, like California.
Okay. Higher wages there, presumably.
A bit higher, yeah. The video uses an example of maybe $25 an hour median wage in California. You'd think that's better, right? An extra few bucks an hour.
You would. But I sense a but coming.
Exactly. The video emphasizes that the cost of living, especially things like rent, can be, well, dramatically higher. Potentially double what you might pay in some other states.
So that higher paycheck just gets eaten up. You might even be struggling more.
That's the picture it paints. And this leads right into the issue of income inequality, which the video really dives into.
Okay, what does it say there?
It argues that, the top 1% in the U.S. controls a huge, disproportionate amount of resources, not just money, but networks, opportunities, all that stuff.
And this isn't just a small gap, according to the video.
No, it claims the U.S. has one of the highest levels of income inequality globally, and that the middle class is actually shrinking.
Which goes back to why using average income figures can be so misleading.
Exactly. It hides this massive divide.
So given that, how does the video portray the reality for lower wage workers?
Well, it looks at the problem of low wages combined with limited hours. It uses Costco as like an example of a company that pays relatively well for hourly work.
How much does it say?
Maybe around $18 an hour base, potentially up to $22, $25 with benefits included.
But is that typical?
The video suggests Costco is more the exception. It then talks about this trend where some employers keep workers' hours just under 30 per week.
Why would they do that?
The video claims it's to avoid triggering the requirement to offer benefits like health insurance because it's so expensive for the company.
Oh, right. So people end up
Juggling multiple part-time jobs, often without any health insurance, no 401k matching from employers.
Yeah.
It's a real struggle. And buying your own health insurance, the video stresses how incredibly expensive that is.
Yeah, I've heard that. And this lack of benefits must really impact retirement savings.
Hugely. The video walks through a scenario. Let's say someone earns $46,000 a year. After taxes, maybe that leaves them with around $37,700.
Okay.
Then it stresses, how vital it is to contribute to retirement accounts, like a 401k, especially if there's an employer match that's free money, essentially, and a Roth IRA, where the video mentions a $7,000 annual limit.
And it explains how those work.
Briefly, yeah. Like with a 401k, you generally can't touch it penalty-free until you're 59 and a half. Take it out early, there's usually a 10% penalty. Plus, you need to set up beneficiaries.
That's a standard stuff, but what's the impact on the budget?
Well, this is the crunch. If you actually maximize those contributions, say, the video uses an example of $11,000 total going into the 401k, your part plus the match, and $7,000 into the Roth IRA.
So that's $18,000 saved.
Right. Suddenly, that $37,700 after-tax income is down to about $29,700, maybe $30,000 for everything else, all your living expenses.
That doesn't sound like much wiggle room.
Not at all. And that everything else is where the video highlights the long-term challenges, especially looking towards retirement.
What kind of retirement expenses does it mention?
It estimates you might need to spend somewhere between $50,000 and maybe over $100,000 per year in retirement.
Oh, Why so much?
Well, healthcare is a big one, especially if you lose employer coverage. Potential long-term care costs like nursing homes and just, inflation making everything more expensive over time.
The video really focuses on U.S. healthcare costs, doesn't it?
It does. It uses this frankly shocking comparison for kidney dialysis, saying it costs 15 times more in the US than in China, yet our life expectancy outcome isn't better.
That's staggering.
It really is. And to put a number on retirement savings, the video cites some government estimate suggesting you'd need about $1 million just for like a basic 13-year retirement.
$1 million.
Yep. And the video is quick to add that with rising costs, that number is probably way too low looking forward. Maybe $1.5 million in today's money, potentially 3 or 4 million decades from now.
Okay, this is daunting. Let's go back to that $30,000 left for living expenses now. How does the video break that down?
All right, it starts estimating annual costs. Health insurance, even with an employer plan, your share might be around $2,500 a year.
Okay.
Food. It pencils in about $5,000 a year, but then notes, hey, if you actually try to eat healthy, lots of fresh food, it could easily be $6,000 to nearly $10,000 a year.
Because fresh food costs more.
Yeah. Then eating out. If you buy lunch out a lot, say $10, $20 a pop, that could easily add another $5,000 annually.
Okay, that adds up fast. What about housing?
Huge variable, obviously. Using a Minneapolis example, it suggests rent might be $1,200 to $1,500 a month, so that's like $14,400 to $18,000 a year, maybe more with utilities.
And way more in places like New York or San Francisco.
Oh, absolutely. Easily double or triple, the video implies. And it mentions the trade-off. Live further out for cheaper rent, but then you pay more in time and money for commuting.
Right. Transportation costs.
Yep. The video estimates car insurance around $2,000 a year, plus any car payments, plus gas. Though, interestingly, it later suggests that $2,000 might even be on the low side for insurance.
Okay. What else? Vacation.
It mentions travel, but kind of dismisses $1,000 a year as totally unrealistic for any real trip.
Fair enough. Phone and internet.
Puts that at maybe $840 to over $2,400 a year, depending on your plan and location. Sometimes higher in less developed areas, it notes.
Then there's just stuff.
Exactly. Miscellaneous expenses, clothes, personal items, things you just need. It calls these essential. Plus, renters or homeowners insurance, maybe $150, $300 for basic coverage.
And it brings up car insurance again.
Yeah, it sort of circles back to emphasize it's a really big expense. It suggests an earlier estimate of $800, $1,500 was probably too low, and that $2,000 plus is more likely, especially for newer cars or younger drivers.
And don't forget unexpected things.
Right, like dental work, needing glasses, co-pays for doctor visits that weren't budgeted.
So when you add all that up against the $30,000,
The video's example shows you easily blowing past it. It presents a hypothetical $10,000 deficit for the year, meaning you're going into debt just to cover basics. It really paints a picture of needing extreme financial discipline, tightening the belt, as they say.
it sounds incredibly stressful.
It does, and the video contrasts this with, say, PhD students who might earn even less, like $20K, $30K, making their situation even tougher.
So just managing day-to-day is a challenge. What about those bigger life goals? Buying a house, having kids.
That's where the video says it gets even harder, even if your income is a bit higher than that 46K example. Achieving those traditional milestones, it's presented as extremely difficult.
So
Well, affording a mortgage, car loans, the sheer cost of raising children. And it specifically mentions things like divorce with alimony or child support potentially being financially ruinous.
the cost of kids is a big one, right?
Huge. The video talks about not just food and clothes, but the pressure and cost of ensuring a good education. That could mean private school or lots of expensive extracurriculars, piano, coding, AP classes stuff parents feel they need to do to get kids into a good college.
And public schools aren't always an easy answer.
The video touches on how public school quality is often linked to local property taxes, so wealthier areas tend to have better funded schools, creating another inequality.
Okay, what about home ownership? The classic American dream element.
The video paints a bleak picture there too. It cites a median national home price around $410,000, much higher in desirable cities.
Unaffordable for many on median incomes.
Exactly. It suggests that for many, homeownership might just be off the table, meaning they rent forever without building equity. Although, it does briefly concede that renting avoids maintenance headaches.
And cars. We need cars in most of the U.S.
Another significant cost. The video mentions a used Toyota Corolla might be $10,000, but describes it kind of negatively, like maybe not the safest or most comfortable option.
And families often need 2 cars.
Right, if both partners commute. And new cars, especially SUVs people seem to want are expensive. $30,000, $50,000, even more. Plus, the loan payments drain your monthly budget
And college costs keep rising.
dramatically. The video mentions tuition potentially hitting $1,000 per credit hour. A bachelor's degree needs, what, 60 credits minimum? So you're looking at $60,000, easily $100,000 or more at some universities, just for tuition.
So adding it all up, what percentage of people does the video think are struggling?
It throws out a figure suggesting maybe 60% of U.S. families are in a financially tight spot, kind of robbing Peter to pay Paul. That's the feeling.
So what does it take, according to this source, to have a reasonably comfortable middle-class life?
The video suggests you'd probably need an individual income around $150,000 a year, or maybe a household income closer to $200,000.
And even that provides...
Basic security, ability to educate kids reasonably well, maybe an occasional vacation. But it suggests even that income level doesn't guarantee significant upward mobility or the freedom to take big risks.
Okay, so even if someone is managing to save diligently, putting money into that 401k and IRA, is it actually enough for a comfortable retirement?
According to this video, the answer is a pretty resounding no. It argues it's becoming incredibly difficult to maintain your pre-retirement standard of living.
And healthcare is a big reason why.
A major one. The video explains that once you retire and lose employer health insurance, your costs can skyrocket. Getting individual insurance, especially with any pre-existing conditions, gets very expensive.
And even if you have savings.
Right. The video uses a hypothetical range, maybe having saved anywhere from $270,000 up to nearly $1 million. But then it points out one major illness with ongoing costs of $100,000 plus a year could wipe that out incredibly quickly.
It mentions people foregoing care because of cost.
Yeah, it touches on that grim reality, people deciding not to get medical treatment they need because they simply can't afford it.
Did it mention that $1.26 million figure again in this context?
Yes, it brought back that 2025 estimate from financial institutions needing $1.26 million just to maintain a basic standard of living in retirement. And the source emphasizes most Americans are nowhere near that number.
Plus, there's inflation eroding savings.
Constantly. The video estimates inflation at like 5% a year minimum, maybe higher for essentials like food and energy. It contrasts this with investment returns.
How so?
It argues that unless your investments are growing faster than inflation and ideally keeping pace with something like the S&P 500's historical growth, around 10–15%, you're actually losing ground financially.
And safe investments don't cut it.
Not according to the video. It uses bank CDs as an example. Maybe they pay 5% before taxes, but after taxes, that's only 2–3%, which is less than the inflation rate it cited.
Yeah.
So you're getting poorer in real terms.
It adds other costs too.
Yeah, it reminds us about dental and vision care, which often aren't fully covered and become bigger expenses as you age.
So the conclusion on retirement seems pretty bleak based on this source.
Very much so. The video basically says that even if you do everything right, save diligently, a secure retirement is becoming unattainable for many. It frames this as a fundamental failure of the American dream promise.
Which leads to the video's final overall conclusion.
The demise of the American dream, as traditionally defined, the video is unequivocal. That vision of a secure life, owning a home, a car, having health care, family, stable job, education, some fun, it argues that's just not realistic anymore for a huge chunk of Americans.
It keeps coming back to housing and kids.
Yeah, it reiterates that median homes are unaffordable, raising kids is incredibly expensive, maintaining that whole middle-class package is just too costly for many. It says for native-born Americans, the dream isn't just fading, it's shattered into atoms. Strong words.
Wow. And it links this directly to income levels.
Absolutely. It suggests earning $50,000 a year offers very little hope, makes basic survival hard, maybe pushes people to skip marriage or having kids.
Even $100,000 isn't enough.
Might still fall short, the video implies. And even $200,000, while better, doesn't guarantee happiness, often coming with high stress and job insecurity.
So what income does it suggest for comfort?
It floats a number around $300,000 a year for a truly comfortable life, but then it immediately notes how difficult those jobs are to get, requiring advanced degrees, publications in top journals or conferences, highly specialized skills like in AI or machine learning.
So accessible only to a very small percentage of people.
That's the clear implication. The ultimate takeaway from the video is that the American dream for the average person in the U.S. today is largely out of reach.
Does it offer any alternative, any solution?
Well, not really a systemic solution, but it does end with this interesting, maybe slightly cynical alternative. A earn good money in the US, but then take that money and move somewhere with a much lower cost of living to actually enjoy it.
Where does it suggest?
Places like Thailand or generally Southeast Asia, it seems less keen on Japan or even China because their costs are rising too. But yeah, geographic arbitrage, basically.
So to wrap up our deep dive into this specific video, it paints a really tough picture. A challenging economic reality where the traditional American dream feels increasingly unattainable for many.
Yeah, the core message is this growing gap between typical incomes and the high cost of, well, everything living basics, healthcare, education, retirement. It's quite sobering.
It definitely leaves you thinking, what kind of systemic changes, if any, could actually address these issues? That's a huge question.
It is. And maybe it also makes you question, how we define success and security in the first place. Do those traditional markers still make sense for everyone?
Lots to chew on there. We really encourage you to reflect on this, think about your own perspective on economic well-being, and definitely seek out diverse views on these big, complex topics.
Definitely. Thanks for tuning in for this deep dive.